the stock exchanges? A stock exchange is a centralized marketplace where publicly traded companies' stocks or securities are bought and sold. It is a platform where investors can purchase or sell shares of companies they are interested in. In a stock exchange, buyers and sellers are connected through a trading platform where they can place orders to buy or sell stocks. The price of a stock is determined by the supply and demand of the market, and the exchange acts as a mediator to ensure that the transactions are completed smoothly and fairly. Stock exchanges also provide a range of financial services, including market data analysis and news updates, which help investors make informed investment decisions. They also provide an avenue for companies to raise capital through issuing shares to investors, which can be used to fund business expansion or other activities. Examples of well-known stock exchanges include the New York Stock Exchange, NYSE, Nasdaq, London Stock Exchange, LSE, Tokyo Stock Exchange, TSE, and Bombay Stock Exchange, BSE, in India. The history of Indian Stock Exchange. The history of the Indian Stock Exchange dates back to the 18th century during the British Raj period. It all started with the East India Company, which was established in 1600. In 1802, the East India Company established the first organized stock exchange in India, known as the Bombay Stock Exchange, BSE. The BSE started as a group of brokers who met under a banyan tree in Mumbai to trade shares of the East India Company. As India's economy grew, so did the stock market. In 1860, the first Indian bank, the Allahabad Bank, was established. In 1875, the Bombay Stock Exchange became an official organization recognized by the Indian government. In 1956, the Indian government nationalized the Reserve Bank of India, the country's central bank. This move had a significant impact on the stock market as it led to the establishment of the Securities and Exchange Board of India, SEBI, in 1988, which regulates the securities market in India. Over the years, the Indian stock market has grown significantly with the introduction of electronic trading systems and the inclusion of more companies from different sectors. Today, the Bombay Stock Exchange is one of the leading stock exchanges in the world. The Indian stock market has been through many ups and downs, from the global financial crisis of 2008 to the recent COVID-19 pandemic. However, it has proven to be a resilient market that has continued to grow and attract investors. And that's the history of the Indian Stock Exchange. A story of growth, resilience, and innovation. What are the reasons or benefits of listing a company on a stock exchange? Well, there are various benefits of listing on the stock exchange. Here are a few. 1. Raise funds. The primary goal of listing is to raise funds. The company can issue fresh share capital to raise funds for growth and expansion. Upon share subscription, there is a considerable inflow of funds from the market. This gives the company the means to meet a sizable part of its financial needs. The funds can also be used to reduce the debt of the company. Thus, listing of securities allows companies to tap into investor funds that can be used for business expansion purposes. 2. Exit route for existing investors. The shares of a lot of private companies are held by several stakeholders including the company's promoters and private investors. If such investors want to liquidate their stake partially or completely, listing on the stock exchange can give them a solution. The existing investors of the company can offer their shares to the public through an offer for sale, OFS, and sell off their shares to the public. Thus, through listing, Existing shareholders can opt for an exit route. 3. Liquidity and marketability of shares. When the shares of a company are listed on the stock exchange, they can be easily traded. The stock exchange is a hotbed of buying and selling of securities, and listing allows the company's shares to participate in their trading frenzy. The shares, thus, become easily marketable and liquid, which motivates investors to own a stake in the company. 4. Increased trust of stakeholders. When the company is listed, it has to comply with the rules and regulations of the market regulator, SEBI. It keeps a tight control over the company's financial disclosures, trading activities, and corporate practices. There is little room for malpractice or fraud. This boosts the confidence of the company's stakeholders in its operations and management. 5. Possibility of takeovers. Listing of securities gives companies the necessary funds with which they can take over smaller companies in the same business for advanced growth. The huge volume of funding also allows expansion of the company, which directly impacts its profitability. 6. Employee motivation through ESOPs. When a company is listed on the exchange, the company can use its shares to attract talents via ESOPs, employee stock ownership plans. This reduces the monetary compensation and retention cost for an employee and increases the chances of recruiting suitable talent. 7. Enhanced visibility. Another advantage of listing is that it creates brand awareness. How many companies did you know before you heard of their IPOs? Through listing, companies can get the attention of investors and analysts who study its fundamental and technical aspects. This creates a public profile for the company and can also play a crucial role in enhancing its goodwill and reputation in the market. What is the process of listing a company on a stock exchange? The process of listing a company on a recognized exchange is quite stringent, as it involves the investment by shareholders all across the country or even abroad. Therefore, to safeguard the interest of millions of investors, the listing requirements and the process for the same are quite strict and require absolute adherence by the companies. The broad steps of listing a company on a recognized stock exchange are: 1. Appointing an investment bank. 2. File the necessary registration forms with SEBI. 3. Issue the red herring prospectus. 4. Increase public awareness about the IPO by means of adequate advertising. 5. Bid for the lots of the shares within the price band set by the investment bank. 6. Determining if the IPO is over or undersubscribed and listing of the shares based on the highest bid. How many stock exchanges are there in India? There are currently 23 recognized stock exchanges in India, as per the Securities and Exchange Board of India, SEBI. However, out of these 23, only a few of them are actively used for trading. The two major stock exchanges in India are the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE, which together account for the majority of trading activity. Other notable stock exchanges in India include Calcutta Stock Exchange, Ahmedabad Stock Exchange, and Madras Stock Exchange. It is important to note that SEBI has made it mandatory for all recognized stock exchanges to have nationwide trading terminals, so that investors can trade securities from anywhere in India. However, despite this requirement, many of the smaller regional stock exchanges have struggled to attract investors and have become less relevant in recent years. In conclusion, the Indian Stock Exchange has come a long way since its inception in 1875. With the adoption of modern technology, The introduction of new financial instruments and the implementation of various reforms, the Indian stock market has emerged as one of the fastest growing and most dynamic markets in the world. Today, the National Stock Exchange, NSE, and the Bombay Stock Exchange, BSE, are the two major stock exchanges in India, serving as important pillars of the country's economy. The Indian stock market has been witnessing a surge in investor participation, both from domestic and foreign investors, and is expected to continue its growth trajectory in the coming years. However, like any other stock market, the Indian Stock Exchange is subject to various risks and uncertainties, such as market volatility, geopolitical events, and regulatory changes. Therefore, investors need to be cautious while investing in the stock market and seek professional guidance to make informed investment decisions. Overall, the Indian Stock Exchange has provided ample opportunities for investors to grow their wealth over the years, and with the right approach and risk management, it can continue to be a lucrative investment avenue in the future.